Okay. I want you to picture a mullet.
A mullet. Like the haircut.
Yeah, exactly. The haircut. Business in the front, party in the back.
Strong start. I assume we're not actually doing a deep dive on 1980s fashion, though.
We are not. We are talking about the future of global finance, specifically this concept called the DeFi mullet.
The DeFi mullet thesis. Yeah, that's a great way to frame it.
Right. So for you listening, business in the front means your clean, compliant fintech app, your Coinbase, maybe even just a regular old bank account. But the party in the back, that is a wild, completely decentralized on-chain protocol moving billions of dollars around.
It's a very catchy meme, I'll give you that. But the reality behind it is, it's actually one of the most significant shifts in crypto history right now. Because that party in the back isn't just random chaos anymore.
It's getting organized.
Exactly. Increasingly, it's taking place on a very specific piece of infrastructure called Morpho.
And that is exactly our mission for this deep dive. We are going to figure out how a project that started as a clever little hack by 3 students in Paris, I think it was Paul Mathis and Merlin.
Yeah, 3 guys in college.
Right, how this college project somehow evolved into what looks like the invisible engine for the entire global credit market.
It really is a fascinating story of evolution, because it's rare to see something pivot so successfully from just a user-facing tool to core back-end infrastructure.
And we've got the receipts for this, too. We've parsed the original white papers, the institutional reports from CoinShares and Binance, and we looked at the technical docs for their V2 launch and this thing called the Blue Protocol.
We've got a lot of ground to cover.
We do. We're going to find out why major players like Coinbase, huge French banks like Société Générale, and massive asset managers like Apollo are all quietly converging on this one protocol.
And the funny thing is, Morpho is now the second largest lending protocol in the world.
Which is wild.
Right. Yet if you ask the average person on the street, or honestly even the average crypto trader, a lot of them have never really heard of it.
Which I suspect is totally intentional.
Oh, absolutely.
Yeah.
They're building plumbing. And if the plumbing works, you don't notice it. You only notice plumbing when it leaks.
Fair point.
But to understand why these absolute giants are choosing this specific plumbing, we have to go back to basics. We have to look at the oldest business model in the world, which is the traditional bank.
Right, okay. The classic spread. So I put my money in a savings account. I get paid, 0.5% if I'm lucky.
If you're very lucky, yeah.
Right. And then the bank turns around and lends that exact same money to you for a mortgage at maybe 5 or 6%. And they just pocket the difference.
Precisely. Nice work if you can get it.
Yeah.
Now, the first generation of DeFi protocols like Aave and Compound, they came along and said, let's just delete the bank entirely.
Remove the middleman.
Right. They wanted to remove the middleman entirely.
Okay.
But they kept the pool model.
Okay, break that down. They kept the pool.
Right. So in a pool model, everyone just throws their digital assets into one giant pot. If you want to borrow, you take from the pot. If you want to lend, you add to the pot.
Which on paper sounds super efficient. It's communal.
It does.
But there's a catch, isn't there?
A massive catch. For a pool to actually function, you need idle liquidity.
Meaning money just sitting there doing nothing. Why is that necessary?
Well, imagine a gym. If the gym sells exactly as many memberships as there are treadmills and everyone shows up at 5 p.m.
It's total chaos. No one can move.
Exactly. A bank or a DeFi pool works the exact same way. If 100% of the money in the pool is borrowed out and you show up and want to withdraw your deposit,
I can't. The money isn't there. It's all out on loan.
right. So to prevent that run-of-the-bank scenario, these protocols are designed to keep a large buffer of cash just sitting there doing absolutely nothing, just waiting for withdrawals. It's stagnant.
And idle cash earns 0 interest.
Correct. So who pays for that inefficiency? You do. The spread exists to subsidize that idle cash. So borrowers end up paying a higher rate and lenders get paid a lower rate just to keep that buffer alive.
Wow. Okay. So evolving Compound removed the banker, but they didn't actually remove the inefficiency of the banking model itself.
You nailed it. And this is exactly where Morpho had their first real aha moment. This was back when they were just students in Paris. They built a product called the Optimizer.
And this is the part that feels a bit like a cheat code. They didn't try to build a brand new competitor to Aave right out of the gate. They built a layer that sat on top of it.
Right. Think of it as a matching engine. The Optimizer basically looks at the pool and says, wait a minute, you want to lend 100 USDC? I want to borrow 100 USDC. Why are we putting this in a giant pod where a chunk of it sits idle? Let's just match directly.
Peer-to-peer, just you and me.
Peer-to-peer. And because we are matched directly, 100% of your money is working. There is no idle buffer needed between us, so we can just split the spread.
Meaning I get a higher yield and you pay a lower borrow rate.
Exactly. That's what economists call a Pareto improvement. No one loses, everyone wins.
Okay, but I have to ask the obvious question here. If we are matched P2P, what happens if I want my money back right now, but you aren't ready to pay me back? If it's just you and me, I'm stuck.
That's the genius of the fallback mechanism.
Okay.
If the optimizer can't find a direct match, or if you need liquidity instantly, it just automatically falls back to the underlying pool, like a Zavi or Compound.
Oh, I see. So it's like we're trying to do a handshake deal in a crowded room because it's cheaper and better rates for both of us. But if we can't find a partner, the bank is standing right there as a safety net to facilitate the transaction.
That's a perfect way to visualize it. You get the pure efficiency of P2P with the liquidity reliability of the pool. It's a brilliant hack.
And that's what put them on the map, right? That's how they got their first $1 billion in volume.
It was.
But there's always a but in crypto. Optimizing someone else's protocol has limits, doesn't it?
It does. It's parasitic in a way. You are building your entire house on someone else's foundation. If Av has a bug, or if the underlying pool suffers some massive bad debt crisis, Morpho catches a cold. You inherit all the risks of the system you're optimizing.
And I imagine for the big institutions, the banks and asset managers we teased earlier, that inherited risk is a total deal breaker. They can't rely on a stack of Lego blocks where the bottom one might suddenly wobble.
Exactly. They need total control over their risk. And that realization led to the second phase of Morpho's evolution. They decided to stop just optimizing others and fundamentally rebuild the foundation of lending itself.
And this is Morpho Blue.
Enter Morpho Blue, yes.
Okay, this is where we need to get a little technical, but let's keep it accessible. When I was reading the white paper for Morpho Blue, one stat absolutely jumped off the page at me. The core code of this protocol is only about 650 lines of solidity.
It's shockingly small.
I mean, for context, most DeFi protocols are thousands and thousands of lines of really complex code, right?
Oh yeah, massive sprawling code bases.
So why does size matter here? Is this just developer minimalism showing off? Or is there a strategic reason?
It's entirely about trust and security. In software, complexity is the enemy. The more lines of code you have, the more places there are for bugs or exploits to hide. By stripping the lending engine down to its absolute bare minimum, just the core logic for lending and borrowing and nothing else, Morpho basically made the code indestructible.
And immutable. That word comes up a lot.
That's the key word, immutable.
Explain that for the listener who might hear immutable and just think it means stubborn.
In this context, it means unchangeable. Once a market is deployed on Morpho Blue, the rules are set in stone forever. There is no admin key held by the developers. There is no governance DAO that can vote on a Tuesday to completely change how your loan works on a Wednesday.
That's huge for a bank. They don't want to wake up and find out that a bunch of anonymous token holders on a Discord server voted to change their interest rate parameters.
Precisely.
Yeah.
It provides regulatory certainty. If an institution builds on Morpho Blue, they know exactly how that code will behave for eternity. It solves the governance risk problem completely.
Now, there's another massive architectural shift with Blair that we have to unpack. The move from shared pools to isolated markets.
This is probably the most important safety feature of the whole system, especially when we talk about preventing total market collapse.
Let's use a visual for this one.
Okay, think of the Titanic.
Not the most comforting comparison for financial advice, but go on.
Bear with me. The Titanic had bulkheads right. Walls designed to stop water if the hull breached. But they didn't go all the way up to the ceiling. So when the water spilled over one compartment, just filled the next one, and the whole ship sank.
Right.
That is the traditional DeFi pool model. It's shared risk.
Meaning if I put in Ethereum and you put in USDC, but someone else comes along and puts in some incredibly risky, volatile meme coin, and that meme coin goes to zero,
the whole pool can become insolvent. My safe assets are suddenly threatened by your risky assets. It's pure contagion.
So how does Morpho Blue fix the Titanic problem?
It basically turns the ship into a submarine with completely sealed watertight compartments. In Morpho Blue, every single market is totally isolated. One specific collateral asset, one specific loan asset, and one specific oracle, the data feed that tells the market the price.
Oh, I see. So if I create a market for lending USDC against that really risky meme coin we mentioned and it completely implodes,
that specific room floods. The lenders in that specific market lose their money, but the market next door, The one lending USDC against Ethereum.
Totally dry.
Totally dry. The contagion absolutely cannot spread.
That makes a lot of sense. And that allows for permissionless creation too, right? Like I could just show up and create a market for literally anything.
Anything you want. It's being called the Uniswap moment for lending.
Meaning what exactly?
Well, before Uniswap, you had to beg a centralized exchange to list your token. Uniswap came along and said, list whatever you want. Morpho Blue does the same thing for credit. It says lend against whatever you want.
Okay, but hold on. I'm putting myself in the shoes of a listener who just wants to earn some decent yield on their savings. If there are suddenly hundreds or thousands of these little isolated watertight markets, ETH to USDC, wrapped Bitcoin to DAI Pepe to whatever, that sounds like a nightmare to actually manage. I don't want to have to audit 50 different micro markets just to deposit my cash safely.
And you just hit on the massive friction point. It's the classic trade-off in crypto. Isolation is amazing for safety, but it is terrible for user experience. If you had to manually move your money around 50 different markets every day to get the best rate, you'd never do it.
So how do they solve the headache? Because clearly people are using it.
They built a layer on top of Blue called Morpho, or people generally just call them vaults.
Vaults. Okay, this sounds like an aggregation layer.
It is. Think of the vault as a restaurant. Morpho Blue provides all the raw ingredients. The flour, the eggs, the meat, which are those isolated markets. But you as a user, you don't want to cook. You just want a meal.
So I deposit my money into the vault, and who is the chef?
The curator.
A curator, so like a professional risk manager.
Exactly. And this is crucial to understand. These aren't just random algorithms or anonymous developers on Twitter. We're talking about professional institutional-grade risk management firms. Companies like Gauntlet Steakhouse Financial or B2B integrators.
Okay, so I, as a regular user, deposit my money into, say, the Gauntlet USDC vault. Gauntlet then analyzes the risk of all those underlying Morpho Blue markets, and they allocate my capital for me.
Yes. They set the parameters. They decide, okay, we're going to put 20% of this vault's capital in the ETH market, 30% in the wrapped Bitcoin market, but 0% in the meme coin market because it's too risky.
It's almost like an ETF for lending. I trust the manager to pick the right allocation.
It functions very similarly. But, and this is the part that makes it truly DeFi and not just a traditional bank, it is entirely non-custodial.
We hear that term all the time. Not your keys, not your crypto. But how does that actually apply here if I've literally given my money to a vault manager to allocate?
It means that even though you delegated the management to the curator, you never actually gave up legal or technical ownership of your assets.
So what happens if the curator goes rogue? Or what if the vault's interface website just crashes and goes offline?
You can still get your assets out. Morpho has this incredible feature called in-kind redemption.
How does that work in practice?
Let's say the vault is illiquid, meaning all the cash you deposited is currently lent out to borrowers. In a traditional bank, if that happened, the doors would lock, you'd have a bank run, you'd be stuck outside.
Right.
In Morpho, you can cryptographically force a withdrawal. The protocol will actually bypass the cash and transfer the underlying loan positions directly to your wallet.
Wait, so instead of getting my cash back, I get the actual loan?
Exactly. You become the direct lender. You bypass the vault completely, and now you hold the claim on the borrower's collateral directly on the Morpho Blue base layer. You can then just wait for the borrower to repay, or if they default, you liquidate the collateral yourself.
Yeah.
You are never, ever locked in.
Wow. That is a massive safety valve. It's the difference between a promise of money and having direct access to the actual money.
It guarantees that the immutable code, not the company running the vault, is the ultimate arbiter.
Okay, so we have the engine, which is Morpho Blue, and we have the steering wheel, which are the vaults. Now let's talk about who is actually driving the car right now, because this is where that mullet strategy we talked about really comes to life.
The institutional adoption.
Yeah.
This is the part that really separates the theoretical hype from reality.
We teased Coinbase at the start. Let's dig into that as case study number 1. Coinbase has this product where you can borrow cash against your Bitcoin.
Right. Now, historically, when a centralized exchange offers a product like this, it's a total black box. You give them your Bitcoin, they give you cash, and you just sit there and pray they aren't gambling with your Bitcoin in the background like FTX did.
Yeah, too soon, maybe.
Maybe. But totally valid concern. Coinbase, however, is doing something fundamentally different here. When you take that loan on their app, they aren't just updating a private spreadsheet on their servers.
What are they doing instead?
They wrap your Bitcoin into CBBTC, which is their version of Bitcoin on the Ethereum network, and they physically deposit it into a dedicated Morpho Blue market. Then they borrow the USDC on-chain to give to you.
So the actual execution of the credit is happening transparently on the blockchain.
Yes, It's entirely verifiable. You can look at the chain right now and see exactly where the collateral is sitting. And the scale of this is massive. We're talking over $1 billion in loans originated this way.
That is the pure definition of the mullet. Coinbase provides the business front, the compliance, the slick app, the fiat on-ramp, and Morpho provides the party in the back, this highly efficient, immutable lending engine.
And because of Morpho Blue's isolation feature, Coinbase gets their own totally separate market. They aren't sharing risk with the rest of the DeFi casino. They have their own watertight compartment.
Which makes sense why they'd trust it. Then you have case study number 2, which is Société Générale. This is a massive French bank founded back in the 1800s. They aren't exactly what you call cyberpunks.
Far from it. Very traditional. But they have issued their own stablecoin called EURCV, which is fully compliant with strict European regulations. And they're literally using Morpho to create lending markets for it.
This feels like a huge milestone, a regulated systemic bank extending its actual loan book onto a public blockchain.
It's the convergence everyone has been waiting for. They are using permissionless public infrastructure to run heavily regulated traditional finance. They just realized that Morpho's rails are fundamentally better and more efficient than whatever legacy software they have running internally.
And finally, we have to talk about the big whale, Apollo Global Management.
The $900 billion gorilla in the room.
Exactly. They recently announced a partnership to buy Morpho tokens and build strategies on the protocol. Why does a private equity giant care about a DeFi protocol?
Because of RWA, real-world assets. Apollo deals heavily in private credit. We're talking loans to real businesses, real estate infrastructure, things that aren't crypto tokens. They see Morpho as the ultimate plumbing to bring those real-world assets on-chain to access global liquidity and leverage.
So in the future, a manufacturing plant in Ohio might be financed by a loan that is technically running through a Morpho vault.
That is exactly the long-term vision.
But I have to ask the obvious question, why Morpho? Why didn't Apollo just use Aave, which has been around longer, or just build their own private blockchain?
It comes right back to that word we keep hitting, immutability. Massive institutions crave certainty above all else. They simply cannot risk building a multi-billion-dollar business line on a protocol that might change its core rules next week via a DAO vote. Morpho Blue gives them a permanent sandbox where they set the parameters once and the code enforces them forever. It completely minimizes governance risk.
It's the difference between building a skyscraper on quicksand versus building it on bedrock.
Exactly. Bedrock is boring, but it holds the weight.
Okay, so we have the pure efficiency of peer-to-peer matching, we have the safety of isolated markets, and we have the usability of vaults. But looking at the roadmap, specifically the reports on Morpho V2, there's still a missing piece to this puzzle. Most real-world businesses do not borrow money at variable interest rates that change every day.
That is the next massive barrier. If you're a corporate CFO, you cannot plan to build a factory on a loan where the interest rate might suddenly jump from 5% to 50% tomorrow just because crypto markets got a little volatile. You need fixed rates.
And this is exactly what V2 is targeting.
Yes. V2 is the shift toward fixed rate, fixed term loans. But they are doing it in a very clever way called intent-based matching.
Intent-based. Okay, that sounds like serious industry jargon. Break that down for us.
Think of it like a dating app for money. Instead of just dumping cash into a massive passive pool, a lender comes to the protocol and expresses a specific intent. They say, I want to lend exactly 1 million USDC at 5% for exactly 1 year. And a borrower expresses their own intent saying, I need 1 million USDC for 1 year, and I'm willing to pay 5%.
And the protocol essentially plays matchmaker.
The protocol, or rather a decentralized network of what they call solvers, constantly scans all these intents and matches them up. It basically turns lending into an order book rather than a pool. This allows for highly customized fixed-term agreements that look a whole lot more like traditional Wall Street finance contracts.
This really sounds like it's moving away from the whole crypto casino vibe entirely.
That is absolutely the goal. The end game here isn't for you, the listener, to necessarily log into a decentralized Morpho app with your Ledger hardware wallet. The ultimate goal is pure invisibility.
Invisibility, meaning it just runs in the background.
Precisely. In the near future, you might open your Revolut app or your Charles Schwab account or Robinhood. You'll see a button that says high yield savings paying 6%. And you just click deposit.
And on the back end, without you ever knowing,
it's running entirely on Morpho rails. The vaults are managing the complex allocation. The blue markets are isolating the risk. But to you, it just looks and feels like a normal savings account.
That is the invisible engine we talked about at the top of the show. It's just plumbing. Nobody thinks about the pipes behind their walls until they burst, but Morpho is trying to build pipes that are mathematically indestructible.
And pipes that can literally connect everything. Stable coins, real-world assets, U.S. Treasury bills, crypto collateral, all of it interacting in one unified, hyper-efficient global credit network.
So to bring this all home for you listening, if you're using Coinbase lending today, you're already using Morpho. If you're out there chasing yield on Base or Ethereum, you're very likely interacting with a Morpho vault right now.
I think the big takeaway from all the source material here is that the hard distinction between DeFi and fintech is rapidly dissolving. The back-end infrastructure is quietly winning. The projects that are stripping away all the bloat and complexity, going down to just 650 lines of code and focusing purely on being reliable, indestructible backends are the ones capturing all the massive institutional volume.
It's truly fascinating evolution to watch, from 3 students in a room in Paris trying to build an optimizer for EV to basically rewriting the back-end code for global credit.
It really is. And I think it proves that in the world of open source finance, the most elegant, secure code, not necessarily the one with the biggest marketing budget or the loudest token, can actually win the day.
So here's a final thought to leave you with as we wrap up. If this DeFi mullet strategy actually works out, if Morpho truly succeeds in becoming the invisible plumbing for the entire world's credit market, does DeFi as a cultural movement sort of just die?
Now, that is a very provocative question.
Really think about it. If in 5 or 10 years we're all using traditional finance apps that just happen to run on better blockchain rails, but nobody actually holds their own private keys anymore and nobody is voting in some chaotic governance DAO, did the crypto movement win? Or did we just end up making the traditional banks slightly more efficient?
Or perhaps by forcing the banks to use transparent, immutable on-chain rails, we force them to be honest without them even realizing it.
Now that is a thought worth chewing on. Thanks for diving deep with us today.
Always a pleasure.
We'll catch you on the next deep dive.